Do you want to grow your wealth without picking risky stocks? Well, in this video, I'm going to show you the 4 ETFs that I would pick myself if I were to start over, even with just $10. Let's check it out. So before we dive in, I would love it if you like and subscribe to this video. That would really be appreciated. So with that, let's jump in and check out what the difference is between an ETF versus a stock. So I'm going to zoom in onto the ETF here first. An ETF is essentially if you buy one exchange traded fund, you can actually access over 1,000 different companies, right? So in this case, you get one bag or one ETF. So the bag is equal to the ETF, but you can get so many different companies like Netflix, like Lyft, like Zoom, and the list goes on. Now, the good news is that if one of these companies, let's say Netflix, for whatever reason, goes bust, in other words, it goes bankrupt, you don't really lose your money. Why? Because it has 999 other companies that are still functioning and still generating some sort of profit. So you don't actually lose your money. However, moving over to stocks, if you buy one stock, that means you actually invest in one company and one company only. In this case, the bag again represents the ETF. And if you're buying one company, you're getting Coca-Cola in this case. Now, if Coca-Cola goes bust, in other words, it goes bankrupt, then that means you actually lose all of your money, which is not what we want, right? And so the ETF right off the bat shows that you are what we call diversified. And that plays a huge role, especially if you're not a full-time market trader. Now let's actually take a look at the differences a little bit more nuanced and bullet pointed. So for ETFs, these are professionally managed. Yes, that does mean that there is a fee, and we'll go over the fees here in a moment. But because it's professionally managed, that also means you don't have to take your own personal time and figure out like when do you buy the stock, when should you sell the stock, and whatnot. And a lot of us, just don't have the time, or maybe it just doesn't make sense to us. So we would prefer to have someone else take care of that aspect for us. So ETFs certainly does that for us. The next thing for ETFs is, like I mentioned before, there's a pool. So you can have a lot of different funds or a lot of different investments or companies in this case in one single ETF, just like the bag. The bag equals one ETF, but in reality, you can get a lot of different companies. It's also less risky. Why is it less risky? Because you are diversified. Diversification helps kind of, eliminate the number of eggs in one basket, if you will. It's also, it can be less liquid, but I'm not really too worried about it, so I'm going to skip over this point. And then there are various types of ETFs out there. So for example, there's specialized ETFs like, I'm thinking here at nanotechnology maybe, so nanotech ETFs. There's something called a growth ETF, which I actually have one later, which we can check out. There are dividend ETFs. There are so many types of ETFs. There's like foreign ETFs, there's domestic ETF. I mean, the list goes on. So there are really cool types of niches out there, even like precious metal ETFs, crypto ETFs, and the list goes on. But it's cool because still, even though these are very hyper specialized, they still have multiple companies within one ETF, right? So even though you're buying a very hyper specialized ETF, you still get access to multiple companies, which means you are experiencing less risk. On the other hand, a stock, just to kind of compare the two, right, you're basically buying individual shares of a company, which means you take on that risk personally. And if that company does well, you do well, which is amazing, right? But chances are that probably doesn't happen, at least not to the majority of us, especially if we have other day jobs other than just day trading and assessing the stock market, which means it's riskier buying one stock because all your eggs are in that one particular basket. It can be more liquid. Again, we're going to skip over the liquidity aspect here. And again, you're investing in one particular type of security. So in this example, it was just Coca-Cola. If Coca-Cola does well, you get the profit. If Coca-Cola doesn't do well, you kind of lose the money, unfortunately, which is what we want to avoid. So if I were an investor and if I had to start all over again, I really want to take a look at my risk versus my reward. And if I'm a newbie, if I'm just starting out, I obviously want to take less risk, but get a decent reward. I'm also being realistic. I know with less risk, I'm not going to get a huge reward. So what am I going to do? I'm going to stick to ETFs over stocks, at least for now, until I get more comfortable. So the difference, we kind of reviewed this already. Again, ETFs have a large number of asset holdings. Mutual funds, I wanted to share with you what the difference is between ETFs and mutual funds, because mutual funds are very similar. However, ETFs, they trade like stocks. I would say that is the biggest difference. Trade like stocks, which means if you buy an ETF at, let's say, 11:23 a.m., you actually get to buy that ETF at 11:23 a.m. And a mutual fund, if you buy it at 11:23 a.m., it actually doesn't set the order until the end of the day, which means oftentimes a mutual fund closes at the end of the day. There are some that offer intraday trading, but we're going to skip over that part. I want to stick to ETFs strictly. The other big difference between ETFs and mutual funds, if I were a beginner, why I would skip over mutual funds, is because expenses here are typically lower for ETFs and mutual funds are generally higher. Why? Because mutual funds are actively managed. While there is management in ETFs, it's generally much more passive and much lower. Another thing that this chart doesn't actually show is taxes. If you hold an ETF in a taxable account, like a trust account or an investment account, your taxes actually aren't going to be that high. However, in mutual funds, there's a lot of what's known as turnover. In other words, because it's actively managed, active management means there's a lot of buying and a lot of selling happening within the mutual fund. And if you hold a mutual fund in an individual investment account or anything that's taxable, your taxes actually are higher for mutual funds and lower for ETFs. Again, that's because ETFs are passively managed typically, and mutual funds are actively managed. So those are some of the bigger differences between ETFs and mutual funds, which again is why for me, if I were a beginner, I would choose ETFs over both stocks and mutual funds. So with that, let's actually jump in and figure out why in general ETFs are ideal for beginners in general. Diversification, we talked about that. Cost efficiency. So we talked about expense ratios. I actually want to show you what the definition of expense ratio is in case you're not familiar with it. So this here is a generic picture of what the basic information of an ETF would look like. So you have management style. This is how the ETF is managed. You have what category is it? Like it's a large ETF, so it's very big, very well known. It's a blend, so some of it is growth, some of it is blue chip stocks. And here you have something called an expense ratio. An expense ratio is extremely important, and this here is oftentimes where my eye goes to first. An expense ratio basically means, hey, here's how much I'm actually paying the fund managers for the privilege of holding this ETF. So it's basically how much you pay for the privilege of investing in this ETF. And the higher the expense ratio, right, the higher the expense ratio, the lower your net profit. Why? Because the expense ratio eats into your overall profit that you make from this stock or bond or ETF. And so if you take a look, for those of you who are interested, expense ratios, they're calculated. Here's an easy example. If you had $1 million invested in a fund, and that fund has an expense ratio of 1%, keep in mind, this example is 0.03%, also known as, another way to write this out is 3 basis points or 3 BPS. In this case, in this example, this is 100 basis points, BPS. Okay, so this is 1%, this is 0.03%, big difference. So in this example, if we have $1 million invested somewhere in a fund, and that fund, that expense ratio was about 1%, and if you invest $10,000 in this fund, you'd pay about $100 in fees each year. So that's generally how it's assessed. An expense ratio is annual. And typically, the way companies charge you is quarterly. So while in this example, it's $100 each year, oftentimes you'll be charged 25%, or I'm sorry, you'll be charged $25 every quarter. That's generally how most institutions charge you on the expense ratio. And of course, it's based on how much money you have invested, right, in the stock market, which means the company, so in this case, the ETF company or the fund, also has a stake in the game, right? They have skin in the game, which means if the ETF value goes up, that means the expense ratio also increases, which means their profit also increases. So everyone kind of has skin in the game. It's good for you too as the investor, because obviously as the ETF increases in value, that means more money in your pocket, right, for you. So it is good, but it also means you pay more. But that's generally how expense ratios are calculated. And then finally, for ETFs, there's also less research, which means you have more time to do the stuff that's important, like family or like vacation or whatever else it is. So you don't really have to put all your eggs in one basket, like in researching what Coca-Cola is. So if I were starting over investing, here's how I would choose my ETFs. First, I would look at 4 buckets specifically, and these are, I'm trying to be as mutually exclusive, collectively exhaustive as I can when choosing my exchange traded fund. So first, I want a fund that really covers the majority of large, well-established US companies like Microsoft, like Amazon. So general US big 500 companies. Then I want also a fund that generates passive income, so dividend income. I also want a fund that has high growth, because typically these guys, income generating and big companies, they're kind of late stage in their cycle, and they're probably pretty well established, which means there's not that much innovation going on. Maybe there is, but there's still, they don't have that much growth potential. And I want a company that's very undervalued and has potential for massive returns. Think Amazon back in the day when it was like very not known. That's what I'm thinking of high growth potential. And then finally, I also want some international fund exposure. I mean, the US generally has pretty good stock market performance and pretty good company performance in general. But what if the US is hit by, I don't know, some sort of stock market crash that really only impacts the US? I don't want to be overweight in US companies and then have, the rest of the world be doing okay. Chances are it's not going to happen, because the entire world at this point is pretty interconnected. So if something happens in the US, chances are there will be some sort of domino effect in the rest of the world. But I do want to diversify my geographic exposure, which is why I do want some international fund exposure. That's my thought process. So with that, let's actually go in, and here's what I would invest in if I were to start over. So first, I would look at Fund 1, which is VOO. VOO is one of my favorites. It's from Vanguard, and I'll show you some breakdowns. But very general, this VOO fund would fall into the very first bucket right here, right? So the general US big 500 companies, because it gives me broad US exposure. And the benchmark, meaning this fund will try to track or will try to follow what the S&P 500 does, which are the 500 biggest companies in the United States. And the expense ratio is 0.03%. It's very cheap. Why? Because average expense ratios, so are about 0.5% or 0.5%, also known as 50 basis points. So this is equal to 0.5%, right? 0.5%. And the AUM, which is equal to the assets under management. So how much money is actually in? How much money do people actually trust to put into VOO? That is about $600 billion. That's a total market value of this fund, which is a lot of money. It's on its way to get to $1 trillion. So it's a lot of money. So let's actually take a look how VOO looks like on the Vanguard website. I took some screenshots to show you what to look for and how I would analyze it too if I were to invest in this fund. So very first thing, I see VOO, I go to the expense ratio. Okay, I'm happy with the expense ratio because it's generally pretty cheap. I also look at this year, what is the asset class? Domestic, so that's telling me it's US, and it's telling me stock general. So this is like blue chip. So it's very well established companies. So blue chip companies, I like that. Okay, good. So check again. The next thing, I'm going to skip over this. I'm going to look here on the right. I'm actually going to compare the expense ratios, so VOO versus average expense ratio of similar funds. This is telling me I'm getting a massive bang for my buck, right? I'm getting a great deal because most other funds that are not administered by Vanguard, this is not, by the way, any type of endorsement for Vanguard. I just personally use this now, and I would do this again if I were an investor starting over. It's just my personal thought process here. But average other funds that are likely not Vanguard, charge 75 basis points or 0.75%, which is a lot of money. In fact, I did a study at my previous company where I worked, and on $1 million, if you had $1 million invested, and the expense ratio, right, so this number here, if that expense ratio differed or was greater by just 0.5%, then guess what? Over a lifetime, over 30 years roughly of investing, that could probably cause you about $1 million in losses, right? Because you're paying that money to the fund company and you're not pocketing it yourself. So it can really have you lose quite a bit of money. So make sure your expense ratio is low, and of course you're investing in a decent fund as well. Next thing I would want to look at is the portfolio composition. So I looked at the expense ratio, I looked at a few other metrics, but I also want to know like what's actually in VU, like what's going on with VU. How does it look like? So first of all, I look at the style box here. This is a very quick visual. It essentially has 9 boxes, and it looks at market capitalization. So how much money is actually in the fund itself? How much do people trust this fund? And then what is the investment style? Is it growth, which means it's pretty aggressive, high risk, also high reward? Or is it more value-based, which is generally like more blue chip, right? Less growth, a little bit more stable, but for that, again, less growth. And so here, because I see blend, I see this middle square shaded, I know right away, okay, these are very large companies. These are probably pretty established. And it looks like it's kind of a mixture between pretty stable, right? This box would be stable. And then growth, obviously this is high growth, but also you got high risk as well. So it's a mixture. And I like that. I like having balance, especially if I were a beginner nowadays. And so some characteristics of this, I want to dig into the numbers now of VU, is how many stocks or companies are actually within this fund. And I'm looking at just VU right now. So, okay, 505. All right, that makes sense. So that's a lot. It's kind of like the S&P 500, which is the benchmark. And the benchmark has 503 stocks. Believe it or not, the S&P 500 actually has more than 500 companies. This mainly has to do with Google, also known as Alphabet, which has different types of share classes. So that's the story behind the 503 and why it's not actually 500. Fun fact. The median market cap here, I see size distribution of companies within a fund's holdings. So how large is the average company that is held within this fund? So this fund, as you can see, the median size of a company within VU is about $258 billion, which again is telling me these are really, really big companies. They're not worth millions. They're worth hundreds of billions of dollars, the average. Earnings growth rate, so again, it's exactly the same, the VU versus the benchmark, 19.4%. This measures the percent of a company's earnings over time. Generally, that number should be going up. And then finally, I'm looking at PE, which is price to earnings ratio, which is a pretty well-known ratio. And this is a company's stock price versus its earnings per share. And the average price to earnings ratio for the overall market is between 20 to 25. We're looking at 24.6 times. So this is right in the average. So I'm not worried. Okay. So that's what I look at next, the style box and the characteristics. Then I want to actually take a look at what's in the portfolio itself. How is the portfolio composed? And so I look at this very nice pie chart, if you will. And it's showing, okay, it's showing what the largest amount in terms of holdings is for VU versus the benchmark. Again, the benchmark is the S&P 500. So I see right off the bat, we're looking at probably the consumer discretionary goods, which are essentially anything that you would buy with extra money that you get, like bonus money that you weren't counting on. So it's generally more, maybe not luxury goods, but fun goods, like maybe retail shopping or things like that, restaurant, going out to eat, stuff like that. Communication services, that's a good chunk. I see that VU very closely tracks what the benchmark is, so that's good. It's essentially not trying to outperform the benchmark, it's trying to perform in line with the benchmark. That's the goal of VU. So you can see a ton of different sectors here, so I like that because it shows it's diversified. We got energy, we got financials, we got healthcare, industrials, which are generally very stable, good during recessions, information technology, the list goes on. So this is good news. Then I just want to take a quick look at what actually is in equity. There's no fixed income. There's no short-term reserve, right? Because this here is strictly big stocks, big companies, which means it's equity. So I see right away we got Apple. Looks like we got quite a good chunk of Apple in this fund. We got Microsoft. Okay, good. So instead of just buying one share of Apple, I can get this one fund, and the fund has Apple and Microsoft, Nvidia, Amazon, Meta, and the list goes on, Berkshire Hathaway, Google, so you get access to all these different companies within one basket of goods. So that's one. The second fund I would get would be this one, SCHD, if I were to start over again. And this fund, which is from Schwab, Charles Schwab, would be income generating. So it would be focusing on passive income. I invest money and I make passive income on the side, which is amazing. Of course, you get more passive income as you start investing more. That's just generally how it goes. And this benchmark generally looks at high dividend US companies, right? So any company that is high dividend, and generally that means greater than 3% in dividends, right? So that's what high dividend means. Okay, cool. So what is the expense ratio here? 0.06%, a little bit higher, but still nothing to worry about in terms of how much you're spending money on. AUM, assets under management, is about $70 billion, so significantly less than VU. Remember, VU was over $500 billion, so quite a bit of money there. Let's take a look at what this Schwab US Dividend Equity Fund looks like. So again, SCHD. And we're looking at the average dividend yield here for this fund is about almost 4%, which is really good. And this is annual, right? So every year you get this 3.92% dividend yield paid out. So that means for every $100 that you invest in this fund, you get $3.92 per year. So again, this is a very good deal in my opinion, especially as you start putting in more cash. So quick look here. So we're looking at this number, 70 billion roughly. Looking at the expense ratio, looking at the ticker symbol, number of securities. So this is telling me that there's about 101 different companies in this particular fund. You get your dividends paid out quarterly. So that means instead of getting $3.92 at the end of the year in December, it's basically $3.92 divided by 4. Roughly, that's how it would work, right? It also depends on the value of the stocks and whatnot, or the value, how much money you put in, but that's generally how it's calculated. You see the equity style box here right away. Again, I can tell value. So this means these are pretty stable companies, but they're pretty large companies, right? So they have a lot of money in them already. I can see here the net asset value, the NAV. This is the difference between a company's assets and liabilities, which means the higher the NAV, also the higher the demand. And you can see how that has changed over time. In 2019 to 2021, the stock market has gone up quite a bit. 2022 did see some inflation. It was about 9%, which also kind of caused the stock market to slow down in performance. So we can kind of see how the NAV versus the market price has kind of changed over the years, but it is making a slow comeback in the right direction. We can see the performance here, right, of versus the Dow Jones, for instance, which could be a decent benchmark compared to this particular fund. So the fund, again, it's not outperforming, but it's staying in line, right? So it's not severely underperforming, it's not outperforming, it's tracking the index. So that's good news. That is the designation of this particular fund and of ETFs in general. Next thing I want to look at is sector weighting. So like how much does each sector account for in this particular dividend generating fund? I can see energy, for example, about 21% of the fund is in energy. Some of it is in consumer staples, healthcare, etc. So this just gives me a good idea of when I might expect volatility, when I might not expect volatility. Generally speaking, dividend funds don't really have that much volatility though, which is good. And then I just want to see, like, for my own purposes, like, whoa, what are the top 10 holdings? And I can see, ConocoPhillips, Chevron. So it sounds like a lot of energy, which makes sense because there's a lot of energy up here. Bristol Myers Squibb, Coca-Cola, interesting, right? Verizon Communications. So this just gives me a good breakdown that about 40% of this fund is held in 10 companies. That's pretty heavy, right? 10 companies equal 40%. So I would love to know, like, what is the makeup of the other 60%? But that just gives you an idea of the fund. Next up, I would look at VUG or VUG, like bug. Fund number 3. This focuses more, so the bucket here is the high growth potential fund, high risk, high potential. So this is for you who are a little bit more risk takers. And I would get this too if I was starting over. The benchmark here is the NASDAQ, expense ratio about 4 basis points. And the AUM is about 150 billion. You can see here, expense ratio 4 basis points. I'm happy with that. And then again, comparison 4 basis points versus 93 basis points for other funds out there with the same composition. So again, you're getting a great bang for your buck with this one. This is the growth ETF. So once again, you got the style box. We're looking at the growth sector and they're large companies. So they're large companies, but they have high growth potential. And so here you can see on average, VUG has about 166 companies, which tracks the benchmark. The average value of the company is about $908 billion. Wow, that's a lot. And you see the PE ratio is much higher than what was with VU. VU was about 24.6, I think, times. And here it's 35.2. And that makes sense because here we're looking at growth. VU was looking more at like domestic stable companies. If you remember, VU was right here. It was a blend, right? It was not growth. So this makes sense. Again, looking at the portfolio composition here, I would be looking at, again, basic materials, consumer discretionary staples, just kind of getting a look at how VUG looks versus the benchmark. And again, they generally track each other quite closely, if not the same. I want to look at the ticker symbols under equities. Again, we're looking at Apple, Microsoft, NVIDIA. This is very similar to the VOO fund, except one of the big differences is this only has 166 companies or stocks, while VOO had a lot more. So that's why it was maybe not performing as high in terms of PE. All right, so there's a little bit less risk in VU versus VUG. And then finally, my last fund is VXUS. So this is kind of cool because the X essentially means except. So V is the companies, Vanguard companies, except the US, anything outside of the US. So that's why it's an international fund exposure and it diversifies beyond the US economy. And the benchmark here is the FTSE Global All Cap ex-US Index. It's essentially an index from the UK stock market index, and it's the top 100 blue chip companies on the London Stock Exchange. So that's just what it means. FTSE, the expense ratio here is 5 basis points, which again is very low. I'm not worried at all. And the AUM is about $61 billion. So that's not bad either, but much lower than what maybe the other ETFs have. Again, we got 5% expense ratio compared to other funds. Again, we're so much lower. We're 81 basis points lower than other average expense ratios for similar funds. So that's good. You can see the number of stocks here. We got 8,500. That's how many you can actually have, different companies, different stocks in here versus the benchmark. And again, this makes sense because this is global. So we're looking at London, we're looking at Germany, we're looking at Argentina, we're looking at Chile probably. We're looking at many different countries and companies. So the average market cap of these stocks is about 40 billion, which also makes sense because you have so much that brings down the average. And the PE ratio is significantly lower than what we've seen with the other ETF funds. But again, it's good to have diversification because here we're not including the United States. So just taking a look at anything here, so regions, now we're looking at regions, we're seeing emerging markets. So these include India, they include, what else? Brazil, for example, different countries like that. So that's a pretty big chunk, about a quarter. Europe, which makes sense, is about 2/5, the Pacific, Middle East, North America, and other. North America generally includes Canada. Again, it excludes the US because this ETF is specifically Vanguard, excluding the United States. And you can see here country, so this breaks it down by country. Japan has quite a bit here, percent of fund. It looks like Japan is the largest percent of the fund, followed by the UK, which makes sense since this is tracking the FTSE. And then finally, we're looking at total international stock ETF. So we're looking at some equity, some fixed income will be included in here, and short-term reserve, etc. Because again, this isn't strictly an equity or a stock fund. This has everything, which can include bonds as well. So here we have TSMC, which is a very, very popular chip producer. You might have heard of them during COVID. SAP, which is German, Nestle, etc. So you got a lot of companies here, and again, you got some folks fixed income. So here's bonds from Argentina. So it goes all over. It's very international. So now finally, how would I create this ETF portfolio for myself, especially as a beginner? I personally would allocate it this way. I would put in VU at 40%. So again, this here's the 500 biggest companies in the US. I would do the dividend the dividend ETF at 30%, so I get some generating passive income. And then the growth ETF, I would put in about 20%. And then finally, international, I would have about 10% of my portfolio take up the international space. So the most important thing is start now. Extremely important. Start building wealth now. And if you found this video helpful, please like and share to help others. I would really appreciate that. Subscribe to my YouTube channel. It's at @the_MMW for more cool insights. And make sure you join my newsletter for more exclusive tips. The link is in the description below. Thank you, and your bank accounts will thank you later.